If you're thinking about buying a home in California, or if you already own one and you're wondering what the heck is happening to your property value, what I'm about to share with you could save you from making a costly mistake. Or maybe, just maybe, help you spot an opportunity that most people are going to miss completely. Because right now, across the Golden State, something is shifting. Home prices in some California cities have already dropped by 40%. Inventory is surging 60, even 70% in certain markets. And if you look at the data closely, really closely, 2026 could be the year when this becomes impossible to ignore. Today, we're breaking down the 10 California cities facing the most serious housing market challenges. We're talking real numbers here: real estate data, Federal Reserve reports, employment stats, demographic trends. This isn't clickbait. This isn't fear-mongering. This is what's actually happening right now. Whether you're an investor trying to protect what you've built, a potential buyer wondering if you should wait, or just someone curious about what's going on in the most expensive housing market in America, stick with me, because the warning signs, they're already here. But before we dive into which cities are at risk, let's take a quick step back. Because if you want to understand where we're headed in 2026, you need to understand where we've been. And I'm talking about 2008. What happened in 2008 and why California got hit so hard? Look, the 2008 housing crash wasn't just a bad year. It was a financial earthquake that shook the entire country. But California got absolutely destroyed. Let me paint the picture for you. In the mid-2000s, everyone thought real estate could only go up. Banks were handing out loans like candy on Halloween. No income verification, no problem. Can't afford the down payment? Here's a subprime mortgage with an adjustable rate that'll reset in 3 years. Good luck with that. People were buying homes they couldn't afford, flipping them for quick profits, and treating real estate like a casino. And California was the epicenter of this madness. Cities like Stockton, Riverside, and parts of the Central Valley saw home prices double in just a few years. It was insane. Then reality hit. Hard. When those adjustable rate mortgages reset and people couldn't make their payments, foreclosures exploded. The entire financial system nearly collapsed, and California led the nation in foreclosures. In some cities, home prices dropped 50, 60, even 70%. Stockton literally went bankrupt. Entire neighborhoods turned into ghost towns with boarded-up windows and overgrown lawns. The median home price in California fell from around $590,000 in 2007 to about $245,000 by 2009. That's a 58% drop. People lost their homes, their savings, their retirement plans, everything. Now here's the thing. After the dust settled, everyone said, never again. We learned our lesson. Lending standards tightened, regulations came in, and for a while it worked. The market slowly recovered. Then the pandemic hit in 2020, and something weird happened. The Federal Reserve dropped interest rates to basically zero. The government pumped trillions of dollars into the economy. People stuck at home suddenly wanted bigger houses. Remote work meant you could live anywhere. And California home prices went absolutely vertical. In 18 months, some markets jumped 40, 50, even 70%. But here's what nobody wants to admit. That wasn't sustainable. It was artificial demand fueled by cheap money and pandemic panic. And now, as interest rates have shot back up to 7%, as tech companies lay off hundreds of thousands of workers, as remote work fades and reality sets back in, we're starting to see the cracks. Is this 2008 all over again? The lending standards are tighter. There aren't as many risky mortgages floating around. But is California's housing market vulnerable? Absolutely. Because when you have home prices that are 10, 12, even 15 times the median household income, when monthly payments eat up 60, 70% of your paycheck, when insurance companies are literally fleeing the state, something's got to give. And that's exactly what we're seeing in these 10 cities. So let's get into it. Number 10, Stockton. All right, let's start with Stockton. And honestly, if any city has PTSD from housing crashes, it's this one. During the 2008 crisis, Stockton got absolutely demolished. Home prices fell over 50%. The city filed for bankruptcy in 2012. It was a disaster. Fast forward to the pandemic, and Stockton had its moment again. Bay Area buyers, priced out of San Francisco and Oakland, started flooding into the Central Valley, looking for space and affordability. Between 2020 and 2022, home prices in Stockton jumped from around $350,000 to nearly $495,000. That's a 41% increase in just 2 years. But now, the party's over. As of 2025, the median home price has already dropped to about $450,000. That's a $45,000 loss from peak. Inventory is up over 40% year over year. Homes that used to sell in 3 weeks are now sitting on the market for 45 to 50 days. And here's the kicker. Over 32% of listings have price reductions. That's one of the highest rates in the entire state. So what's driving this? A few things. First, mortgage rates are hovering near 7.1%. That means monthly payments on a median-priced home are around $3,250, even with 20% down. For a city where the median household income is only about $68,000 a year, that math just doesn't work. Second, the job market here is rough. Unemployment is sitting at 6.3%, which is above the state average. Stockton's economy leans heavily on logistics and agriculture, and both of those sectors are getting hit by automation and economic uncertainty. And third, those Bay Area buyers who drove the boom, they're gone. Remote work is fading. Companies are calling people back to the office, and suddenly that 2-hour commute from Stockton to San Francisco doesn't seem worth it anymore. Looking ahead to 2026, if interest rates stay high and the economy slows down, Stockton could see another 8 to 12% drop. And given its history, that's honestly a little scary. Number 9, Sacramento. Sacramento is interesting because it was sold as the smart alternative during the pandemic. You get more space than the Bay Area, lower prices, and you're still close enough to San Francisco for weekend trips. Between 2020 and 2022, people bought into that story hard. Home prices shot up from about $380,000 to $540,000 at the peak. That's a massive jump. But in 2025, reality is setting in. The median home price has already fallen to around $460,000. That's nearly an $80,000 drop, or about 15% from peak. And the data gets worse when you dig deeper. Inventory has exploded. We're talking over 5,000 active listings right now, which is a 46% increase year over year. Days on market have stretched from 27 days to over 44 days, and about 36% of listings show price reductions. Here's the brutal truth. Sacramento's boom was driven almost entirely by people leaving the Bay Area. Tech workers with San Francisco salaries could suddenly afford a nice house in Sacramento and work from home. But that wave has reversed. Return-to-office mandates are pulling people back, and those who do stay remote are realizing they can live anywhere. So why stay in California with its high taxes and cost of living? The job market in Sacramento is also challenging. Unemployment is around 6.1%. The economy is heavily dependent on government jobs and healthcare, neither of which are seeing the kind of wage growth that would support these elevated home prices. At current mortgage rates, a $460,000 home requires monthly payments of about $3,500. For a city where the median household income is roughly $75,000, that's stretching people thin. And it shows. Sales activity is down. Investor interest has dropped 40% since 2022. The momentum is gone. Looking toward 2026, Sacramento could see an additional 8 to 15% decline if demand continues to weaken. We're probably looking at prices settling somewhere around $390,000 to $420,000 before things stabilize. Number 8, Riverside. Riverside in the broader Inland Empire used to be the ultimate affordability play for Southern California. You couldn't afford Orange County or LA? No problem. Head east, deal with the commute, and you could still get a house with a yard. During the pandemic, this strategy worked. Home prices in Riverside climbed from about $475,000 in 2020 to roughly $575,000 by 2022. But the cracks are showing now. The median price has dipped to around $540,000, which is about 2.5% down year over year. But the real concern is what's happening beneath the surface. Inventory has jumped nearly 50% compared to early 2024. Days on market have extended from 28 days to over 40 days, and 36% of listings are showing price cuts. Here's the reality check. At current mortgage rates, a $540,000 home costs about $4,100 a month with 20% down. That's before taxes and insurance. For a city where the median household income is around $72,000 a year, that monthly payment is crushing. Investor interest has cooled dramatically too, down about 40% since the market peaked. Cash-on-cash returns have collapsed as rental yields compress and property values slide. For 2026, Riverside faces continued downward pressure. We could see another 8 to 12% decline, especially if the broader economy weakens. Number 7, Bakersfield. Bakersfield represents a different kind of problem. This isn't a city suffering from luxury overload or tech worker exodus. This is a city where even affordable isn't affordable anymore. Between 2020 and 2022, Bakersfield attracted buyers looking for extreme value. Median home prices climbed from about $330,000 to $385,000. But today, prices have barely moved, sitting around $375,000. And while that sounds stable, the underlying market is showing serious stress. Here's the issue. At current mortgage rates near 6.9%, a $375,000 home comes with monthly payments of around $2,800. That's before property taxes and insurance. In a city where the median household income is barely $58,000 a year, that's almost 60% of gross income just for housing. That's unsustainable. The job market is also challenged. Bakersfield's economy leans heavily on oil production and agriculture, both of which are under pressure. Official unemployment is at 7.2%, but if you factor in underemployment and job quality issues, the real number is probably closer to 10 or 11%. And then there's the insurance situation. After a series of wildfires and droughts, homeowner insurance costs have jumped significantly. Some policies have doubled or tripled in price. For residents already stretched thin, that extra $200 or $300 a month can be the breaking point. Looking at 2026, Bakersfield faces continued softening. Potential declines of 6 to 12% are realistic as the economic fundamentals remain weak. Number 6, Long Beach. Long Beach was always marketed as LA County's more affordable coastal option. You get beach access, decent weather, port city vibes without the insane price tags of Santa Monica or Manhattan Beach. Between 2020 and 2022, that positioning drove significant appreciation. Median home prices climbed from about $640,000 to roughly $880,000. That's a 37% jump. But today, prices have settled around $820,000, representing an 11% decline from peak. More importantly, the market dynamics have shifted completely. The core challenge for Long Beach is that its economic health is tied directly to LA and the Port of Long Beach. As commercial real estate struggles in Los Angeles, as office towers sit empty and businesses cut back, those ripple effects wash up on Long Beach's shores. Many buyers who were attracted to Long Beach were people priced out of LA proper, but still earning LA area salaries. As tech companies, entertainment firms, and other employers reduce headcount through layoffs and automation, that demand base weakens. For renters, things aren't better. Average 2-bedroom apartments now cost about $2,900 a month, which is over 42% of median household income. That's well above the recommended 30% threshold. At current mortgage rates, monthly payments on a median Long Beach home exceed $5,800 with taxes and insurance. For a city where median household income is around $82,000, that's simply out of reach for most people. Looking to 2026, Long Beach faces continued softening with potential declines of 10 to 18% from current levels if economic conditions don't improve. Number 5, San Jose. San Jose is Silicon Valley's unofficial capital. and for years its housing market seemed bulletproof. Tech wealth, stock options, venture capital money, it all flowed into real estate. Between 2019 and 2022, median home prices surged from about $930,000 to $1.58 million. That's a 70% increase. But 2025 has been a reality check. The median home price has fallen to approximately $1.45 million, representing an 8.2% decline. And while that might not sound dramatic, the market indicators tell a clearer story. The fundamental shift is employment. Since January 2024, major California tech companies have eliminated over 312,000 jobs. Google, Meta, Amazon, Tesla, they've all implemented significant layoffs. These weren't entry-level positions. We're talking mid-career and senior roles paying $150,000 to $300,000 annually. These high-income earners were the only demographic capable of supporting million-dollar-plus price points. As they lose employment or see their compensation drop through stock losses, demand contracts sharply. At current mortgage rates, monthly payments on a $1.45 million home hover around $9,600 even with 20% down. Add in Santa Clara County's property taxes, about $1,600 monthly, plus insurance close to $500, and you're looking at total monthly costs above $11,700. That's more than most families in the city earn in a year. Looking toward 2026, San Jose faces continued correction pressure. If tech layoffs continue and remote work remains popular, additional declines of 12 to 20% are plausible, potentially bringing median prices toward $1.1 to $1.25 million. Number 4, Santa Cruz. Santa Cruz is the bohemian beach town that combines coastal living with proximity to Silicon Valley and a university presence from UC Santa Cruz. Between 2020 and 2022, these factors drove substantial appreciation. Median home prices climbed from about $850,000 to roughly $1.15 million. Today, prices have settled at around $1.08 million, representing a 6% decline. But market indicators suggest a deeper correction is coming. Inventory has increased about 38% year over year. Days on market have extended to over 48 days. Price reductions appear on roughly 31% of active listings. Monthly mortgage payments on a typical Santa Cruz property reach about $6,900. With property taxes around $1,100 and insurance approximately $450, total monthly costs near $8,500. That's over $100,000 annually, completely out of reach for most local residents. Santa Cruz also faces specific vulnerabilities. Wildfire risk means coastal insurance premiums often exceed $450 monthly. Rising sea level concerns impact valuations in certain neighborhoods, and rental costs have escalated to about $3,400 monthly for two-bedroom units, consuming 44% of median household income. For 2026, Santa Cruz faces potential declines of 12 to 18% as the affordability crisis becomes untenable. Number 3, Oakland. Oakland is a fascinating case because it shows how quickly market sentiment can reverse. Between 2019 and 2022, Oakland benefited massively from Bay Area spillover demand. Buyers priced out of San Francisco looked across the bay. Median home prices jumped from about $675,000 to a peak of $950,000. But today, that narrative has completely flipped. The median home price has fallen to approximately $885,000, a 7% decline, and the market shows genuine weakness. The fundamental shift involves both supply and demand. On the supply side, pandemic-era remote workers who moved to Oakland are relocating back to higher-income job centers or leaving California entirely. On the demand side, Oakland faces serious challenges. Crime concerns, particularly property crime, have more than doubled compared to national averages. Visible homelessness across downtown corridors creates hesitation among potential buyers. Infrastructure struggles from decades of underinvestment are apparent everywhere you look. At current mortgage rates, monthly payments on a median Oakland home exceed $5,400. For a city with median household income around $86,000, that represents an unsustainable burden. Looking to 2026, Oakland faces continued downward pressure with potential additional declines of 10 to 16% likely if current trends persist. Number 2, San Diego. San Diego enjoys several advantages that create more stability than many California peers. Military presence provides employment stability. The biotech sector offers high-paying jobs. The climate and lifestyle are genuinely appealing. The median price has fallen to approximately $815,000, representing a 7% decline. More significantly, inventory has increased to a 10-year high, up about 61% year over year. That's a massive supply surge. The challenge reflects broader state trends. While military contracts remain stable, biotech sector employment has contracted as companies implement efficiency improvements. Some operations are relocating to states with lower costs. At current mortgage rates above 7%, median home prices require monthly payments exceeding $6,000 with 20% down. For a city with median household income around $85,000, that creates extreme stress. Additionally, San Diego faces insurance pressures. Coastal and fire-prone properties face substantially elevated premiums. Some policies now exceed $9,000 annually. That invisible carrying cost compresses affordability further. Looking toward 2026, San Diego faces moderate correction pressure. While fundamentals are stronger than many California peers, affordability challenges suggest potential declines of 8 to 15% from current levels. All right, number 1, Irvine. And honestly, this one surprises people because Irvine is supposed to be rock solid. Excellent schools, meticulously planned communities, low crime, beautiful infrastructure, strong corporate presence. It checks every box, but that velocity was unsustainable. Today, the median price has fallen to approximately $1.48 million, a 7.5% decline. However, market signals suggest a deeper correction is coming. Inventory has jumped 55% year over year. Price reductions appear on about 30% of listings. Days on market have extended to 44 days, up from less than 20 during the boom. The fundamental issue is pure affordability mathematics. With median household income at about $110,000 annually and median home prices at $1.48 million, the price-to-income ratio is roughly 13.5 to 1. That's economically unsustainable. Even high-income professionals are being priced out. Teachers, nurses, even engineers at some companies can't afford to live here anymore. And investor activity has cooled dramatically, down over 40% since 2021, as rental yield mathematics have deteriorated. Looking toward 2026, Irvine faces significant correction risk. Potential declines of 12 to 20% appear probable as the affordability crisis reaches a breaking point. So what does all this mean? Look, these 10 cities represent what's happening across California's broader housing market. The common thread is simple. There's a fundamental mismatch between home prices and household incomes. It's not complicated. People can't afford the homes being sold. Additionally, interest rates above 7% have destroyed the financing mechanisms that previously let buyers stretch their budgets to unsustainable levels. You could maybe justify a $1 million home when rates were 3% and your monthly payment was $4,200. But at 7%, that same home costs $6,650 monthly. That's a 58% increase in carrying costs for the exact same property. Tech sector employment contraction has eliminated the high-income base that supported luxury segments. Rising insurance costs, driven by wildfire and climate concerns, have added invisible carrying costs that compress affordability even further. For 2026 specifically, expect continued inventory accumulation, sustained downward pressure on prices in the 8 to 20% range, depending on location, and a general transition from sellers markets to genuine buyers markets in most major California cities. If you're currently a homeowner in any of these markets, focus on realistic assessments of your property's value and your long-term plans. If you need to sell, understand that waiting might mean accepting an even lower price. The market isn't turning around quickly. If you're considering purchasing, recognize that waiting will probably offer better entry points and reduce downside risk. We're not at the bottom yet in most of these markets. If you're an investor, understand that traditional buy and hold strategies may produce negative returns in the near term. The appreciation game is over for now. If you can't make the cash flow math work at current prices, don't count on price gains to bail you out. The California housing market of 2026 will look fundamentally different from the pandemic-era mania of 2020 to 2022. That difference will create both challenges and opportunities depending on how prepared you are. Thanks for watching. If you found this helpful, please subscribe and hit that notification bell. I'll be tracking these markets closely and updating you as things develop. Drop a comment below and let me know what you're seeing in your local market. Are prices holding? Are they dropping? Are you seeing more inventory? I read every comment. And hey, if you know someone thinking about buying or selling in California right now, share this video with them. They need to see what's really happening, because the real estate agents and the headlines aren't going to tell them the full story. Stay informed, stay smart, and I'll see you in the next one.